Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Hi everyone, thank you for tuning in today. We are starting a new series called Conversations to Have with Your Advisor, and today we'll be talking about market volatility. I have Samyukta, my colleague, who will be joining me as well. Hi Samyukta. I think earlier today we were discussing about how we are 6 months into 2023 and how in the beginning of the year there were a lot of expectations about returns in the market being muted and it being an extremely volatile year, and it's going to be difficult for investors to make choices in terms of investing and seeing returns. But things have quite changed in the last few months because there isn't as much as volatility as it was expected, and markets are somewhere close to an all-time high. So the emotions with the investors and the decisions that they are making are all quite different from how they started off in the beginning. So how do people actually measure this volatility, and how can it actually help in terms of investors trying to understand what is exactly happening?
So, I think from a behavioral perspective, when the markets are volatile, the ease with which you make a decision actually reduces, and there can be some stress on that side. But the way to measure volatility is through the volatility index or the VIX. And what we've actually noticed is that, contrary to what the expectations were at the start of the year, this year has been much less volatile than expected, right? So, and is this a good thing? Because we're talking about how it's difficult to make decisions when markets are volatile. So, not having volatility, is that actually a better thing for investors? And this is where it gets a little bit tricky, because what could happen is that we know that markets tend to revert to their mean, right? So, if you're used to a period of normal volatility and then you go into a period of low volatility, then to get back to normal volatility, you're probably going to have more extreme reactions to events. And that's a situation that actually requires a little bit of preparation.
Right. So, in terms of what can investors do today so that they protect themselves against the volatility as well, is I think largely ensuring that asset allocation is something that they consider into. So, instead of just being blindly associated with let all my money go into equity or let all my money go into debt because it's an interesting year for debt as well, I think most investors should look into in terms of their overall portfolio of how their assets are and look at how they want to rebalance it and align it to their goals and their risk measures as well. And as and when they are getting lump sums, I think it would be wise for them to measure and buy the dips. And also, whoever has the capacity to do an SIP can continue to do an SIP or even channelize their lump sums through the format of STPs as well, so that they will be able to average the costs over a period of time.
Right. And I think the thing that actually holds people back, these are all simple, effective strategies, right? Follow something related to asset allocation, systematically invest, whether that's in terms of like a monthly contribution or ad hoc contributions that you split over time. I think what tends to hold people back is that, one, they're not prepared, right? So having this conversation about, okay, the market has not been volatile, but it could be volatile. So getting into that conversation with your advisor is actually a really good starting point. And it allows you to take certain actions today. Like, let's say you want to restructure your portfolio. It makes sense to do it when the markets are buoyant and not at the bottom, right? You would also be a little bit more reluctant to do serious restructuring when your portfolio is down. The second thing I feel is that mentally maybe you've had this conversation, but you've not acted on certain decisions, which means that when the time comes to invest, you may not have the right asset allocation to help make those moves, or you may not have enough liquidity at that point. And then I think the last thing is that when you see volatility and you're not expecting it, you might even stop your systematic investments, right? Because suddenly you're exposed to this market which is behaving very differently from what you imagined or what you expected. So then even the systematic investments, which kind of manage volatility really well, is something that you hesitate to do. So these are, I think, things that we can avoid with a serious and constructed conversation with your advisor.
So hope that video was useful for you and you could go and reach out to your advisors and have a conversation with them about market volatility and how you need to manage your portfolio. Watch out for the next episode.